This episode is brought to you by Marqeta, payment programs that scale and customer experiences that inspire. Don't sacrifice one for the other. Choose a payments provider who can deliver on both. Choose Marqeta. Learn more at marqeta.com/FTT. Hello, and welcome back to the Fintech Takes podcast. Today, I have yet another edition of our new podcast show that we've been doing, Facing Credit, which is all about everything happening in credit and lending. As you probably have observed, I've been trying to sort of recruit the super team of recurring guests to come on the Facing Credit podcast, my sort of favorite lending and credit nerds, people who've forgotten more about the subject than I will ever know. And today's guest is certainly a founding member of that nerd team. Dave Wasik is a partner at Second Order Solutions, which is a consulting and advisory firm that focuses on credit risk and working with chief risk officers at banks, at fintech companies. It's a lot of ex-Capital One folks who are kind of the smartest people in the world when it comes to credit risk. And Dave in particular really talks about credit risk and what's happening from a consumer lending perspective better than just about anyone I've met. So I wanted to have Dave on to kind of do a State of the Union, so to speak, on the state of consumer lending credit performance and how different loan portfolios in the market are holding up. So we kind of do an overall state of the big picture of the consumer credit as of December 2025 using some updated data that Dave just got from his work with the credit bureaus. And he gives us a bit of a state of the union on that. And then we dive into all of the different kind of product areas that sit within the consumer credit umbrella. So we talk about credit cards and the fact that credit card performance continues to hold up pretty well, despite it roaring back to above pre-pandemic levels. We talk about auto lending, where we are starting to see some signs of maybe not flashing red lights, but flashing amber lights and what we think that means. We talk about BNPL. We talk about student lending, which is just a fascinating subject because it's just as much a public policy discussion as it is a credit risk discussion. And then, we talk about some of the kind of less heralded risks or things that Dave worries about when he looks at the next 6, 12, 18 months of consumer credit performance for U.S. banks and fintech lenders. It was a great discussion. I was sort of frantically taking notes as we were talking, which you might be able to hear in the background. But that's just how smart Dave is on this stuff. We're going to have him and other folks from Second Order Solutions back on future episodes. But for now, please enjoy my conversation with Dave Wasik. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, Dave, thanks so much for joining me.
It's great to be here. Thanks a lot, Alex.
Yeah, I am delighted. We were joking before we hit record that the genesis of the idea to do a credit-focused podcast, this Facing Credit podcast, actually really took root at a dinner that you and I both attended, hosted by Nova Credit a few months ago. So I'm glad that you're finally coming on and we're bringing that idea fully to fruition.
Absolutely. Yeah, it's great to see it out there in the world.
I think so too. And I mean, you're a truly committed nerd as it relates to all things credit and lending and credit risk. So you are exactly the right person to bring on. You have some updated data that I believe that you guys get through some work you do with Equifax. And it's really timely, actually, because one of the conversations I've been wanting to have for a while is just kind of what's going on with lenders' portfolios, right? And so I'm hoping that we can just, as of December 2025, kind of unpack what's happening in consumer credit broadly. And I have some specific areas I want to get into. But before we do that, maybe you could just start with a sort of overarching picture on where we are, big picture, with consumer credit in December of 2025.
Yeah, sure. First of all, I definitely take no offense at being called a nerd. At Second Order Solutions, we view that as a term of endearment, and right. So I know I'm among fellow nerds on this podcast. But yeah, in terms of just the overall picture of things, one of our clients is a chief credit officer at a large bank, and he told us this story, which has stuck with me, which is, if I had been living in a cave for these last several months, no phone, no internet access, the only human interaction I had was once a month someone would bring me paper printouts of my monthly credit reports and portfolio reports, I would be pretty happy. Things would be looking pretty good. I would even be thinking about, expanding credit.
Stepping on the gas
maybe
a little bit. Yeah.
But, in this kind of just with so much uncertainty and murkiness kind of looking out into the future, like it's going to be a much harder sell. And I feel like that's a good summary of where we are today, where delinquency rates are elevated in really all of most of the major consumer asset classes relative to pre-pandemic. Auto delinquencies are up about 60%. Card delinquencies are up about 30% relative to, say, the last 3 months ago. Things don't appear to be getting any better. You could make an argument that maybe if you squint, things are eroding a bit. But in general, delinquency rates are high, but reasonably stable. And as you can imagine, just hearing all the news about a murky unemployment picture and the seeming inevitability that tariffs will lead to greater inflation. There's worries about the housing market and the stock market both feeling overheated. So looking forward, things look concerning, but looking at the present tense, things have been pretty good for the vast majority of lenders.
Interesting. That's fascinating because I like the way you described that, and it kind of fits with, I think it was Kyla Scanlon who coined the term vibe session a few years ago to sort of describe this like divergence between sentiment and numbers. And it seems as though that's kind of showing up a little bit in the credit space as well. To your point, obviously, we've fully rebounded from where we were to the pandemic and gone beyond that, both in terms of delinquency rates and also just like the overall like volume of lending, right? But to your point, it's been fairly steady, since then. And it's not like we're seeing massive signs of deterioration. And yet, I think you characterize the mood of it well too. Like if you're not living in a cave, getting those printouts and not having any other sort of interactions, you guys talk to chief risk officers all the time. That's who you work with. Like all of them have this kind of like nagging feeling of like something bad, maybe right around the corner. It's good to be cautious. We shouldn't try to expand the credit box right now. Like now's not the time. So let's get into some of the specific asset classes, because I think that you do see slightly different stories, kind of asset class to asset class. Let's start with credit cards, which I would say, from my layman's point of view, seem to be one of the ones that's kind of bounced back in terms of usage the best, kind of post-pandemic. Like we're back, we're sort of at all-time new highs in terms of sort of usage of credit cards. I think issuers are reporting like good usage and volume, and like the numbers are good for credit card issuers. And to your point, delinquencies have held up relatively well, right? So like what's causing, I guess, what I would classify as maybe this sort of resilience in the credit cards market right now?
Yeah, well, just as you said, like as a nerd, I'm generally uncomfortable with vibes-based arguments, but we just finished an election where every candidate that ran on an affordability platform won, right?
That's right.
Consumer credit or consumer confidence surveys continue to look bad. So it's this dynamic where lots of people seem to be crying out that things are not going well for them, as yet they keep paying back their credit cards. And the credit card is a remarkable product. I mean, just looking way back to the Great Recession, like every asset class did badly, but credit cards did the least badly of the group. And I think I can think of a couple of reasons. One is, as we sit here today, the value proposition for a credit card is super clear. There are certain types of transactions like renting a car, booking a hotel room that you need a credit card for. And then increasingly, more and more customers have some form of rewards on their credit card. That creates this like banked pool of rewards that, it creates a sense of stickiness that you just don't see on a personal loan or an auto loan or what have you. So if that's the consumer piece, I then think there's the competitive market, and a couple of things jump out at me there. One is it's a relatively consolidated asset class, meaning the top 10% or the top 10 credit card issuers control 82% of the credit cards outstanding. And, these are, banks, this is Chase and Citi and Capital One and Amex. And, these aren't like move fast and break things kind of companies. Like these are serious, well-managed, highly regulated institutions. And while they're not infallible, like they're not irrational either, right? And so it's a relatively safe set of hands for the product. And then the last thing is like minimum payments are flexible and low. If you've got an auto loan, we'll talk about auto loans later on, I'm sure.
Yeah.
Your minimum payment is several $100s every month. Whereas, the credit card allows you to ride out like temporary cash flow constraints because your minimum payment might only be $100. And so there's even like structural things about the product that I think help carry it through a time like this. So again, I grew up in the credit card business. I've got a fondness for it, but it's a very resilient and successful product.
So I think that's exactly the right way to categorize credit cards, right? And you hit on a couple different points that I just want to emphasize really quickly. One is the sort of affinity that customers have for credit cards, right? And I think, I mean, tell me if you disagree, but I think it's sort of a combination of the utility of credit cards, which is like, this is kind of the most general purpose liquidity solution that most consumers have. And so we saw this during the Great Recession, like asset classes didn't perform the way that we maybe thought they would historically because consumers looked at them purely from a utility perspective and found that like, hey, my car might be more valuable than my house right now, or my credit card might be more valuable than my car. Like people make different decisions around the utility of these products, combined with the fact, and you illustrated this as well, in the US, consumers love credit cards. They love credit card rewards. I think in a lot of cases, they think of their credit card issuers as their primary bank, at least on the payment and spending side, if not the deposit side. And so it does feel like they prioritize taking care of their credit cards over other products. The point you made about the utility of the card in terms of its repayment cycle, I think is also a good one, just in that the utility is going to be significantly kind of flexible relative to auto or mortgage or whatever. And so if you need to throttle down, throttle up, if you need to revolve for 1 month and then get back to transacting, like you can do that and you have some level of flexibility, which I think is great. And then the third point, and this is maybe one I want to press you on a little bit because I think it's really interesting and relevant to some other asset classes, is the steady hands, which I think is a great way of thinking about it, right? Because like the market is concentrated in the hands of these large issuers. You know this better than anyone. Like the credit risk folks at these large issuers, they are the most experienced, have the most scar tissue, have the best kind of feel for like when to step on the gas, when to take your foot off the gas, how to talk to the C-suite about, we need to kind of take a slight step back on profitability this quarter, but trust me, it's the right thing to do, blah, blah, blah. They can assess what their competitors are doing. I also think sometimes in a market like this, reminds me of that quote. I can't remember who said it, but it's like, the most dangerous swordsman is a novice because they'll just do shit that like you don't understand, and you get stabbed in the face because they stepped left when they should have stepped right. I think that applies in the financial services sector as well, where like all of these guys know each other, right? And so like Capital One knows what Amex is going to do. They know what Chase is going to do. Chase knows what Citi is going to do. And there's a certain dance they can all do among themselves and not take anyone else by surprise. the reason I think that's an issue worth kind of poking at a little bit is, and I'm sure you guys have been helping with some of the companies that are working on this. Credit card is a big growth area for companies that haven't been in credit card historically, right? So obviously,
Right.
we saw Robinhood buy X1 and sort of launch its credit card. Coinbase is launching a credit card. There's a bunch of fintech companies, and not just like the credit builder cards, which we don't have time to get into, Dave, because that would take us down a whole different path.
Yeah.
But like, more kind of prime or super prime competitors getting into the credit card space, because credit cards are a great product. They're profitable. They're, something you can kind of dynamically manage risk around. That also suggests to me that we're going to have some novice swordsmen getting into the space potentially, and the competitive dynamics might change, not so much from a volume perspective over time, but at least in terms of like the competitive dynamics. Do you see that potentially around the corner as something to watch in the credit card space? When it comes to your payments provider, you can't afford to compromise. Marqeta's modern payment solutions flex with your business without the trade-offs. Stable and agile. Secure and innovative, scalable and configurable. If they say you can't have it all, don't believe them. Your business demands more. Choose a payments provider that delivers more. Choose Marqeta. Visit marqeta.com/FTT to learn more.
Yeah, for sure. Right. Like usually the word bureaucracy almost always has a negative connotation, but in this particular narrow definition, like bureaucracy can be your friend when you're a top 5 bank and there's a first line of defense credit team and a second line of defense credit team that have different, often like, opposite sets of incentives. That means that things move slowly, but sometimes it's good for things to move slowly. And so as we see, the new fintech entrants into the space, you've got people like Cardless and Imprint and Marqeta who are definitely ramping up well and definitely care deeply about credit. The issue is that oftentimes that it is difficult to both grow a credit card business rapidly and do it in a really well managed way, especially if you don't have the like institutional wounds that come from kind of having lived through a recession. And so it's a fascinating space, and I definitely, to your point, see a number of different like challenger entrants coming up as well.
Yeah, well, and I that takes us to another area I wanted to ask about briefly, which is buy now, pay later, right? Which is, I guess, kind of the other side of the competitive forces kind of pressing on credit card issuers. And, I think we've seen some acknowledgments, quite frankly, from some of the large card issuers that they at least need to take BNPL seriously. So some of them have added kind of pay later functionality onto their cards. Some of them have even started kind of getting more directly into the buy now, pay later business. They all at least are acknowledging the growth of buy now, pay later and its impact on credit cards. From a consumer perspective and a risk perspective, where are you seeing BNPL pop up?
Yeah, it's interesting. If I think back to what I'll call the early days of BNPL, but this would have been, say, 7 or 8 years ago, most of the big spending categories that BNPL was playing in were bigger ticket items that had lifespans of a few years, right? These would be televisions and computers and tires and mattresses, like a lot of the domain of more traditional point of sale lenders. What we're seeing now over time is a shift towards BNPL being used for more everyday convenience sort of purchases, groceries or restaurants or carryouts or those sorts of things. I saw an article even yesterday that talked about the increase in BNPL delinquencies year over year. Yeah. And that was part of what they emphasized is if you just think of it from a consumer perspective, it's a very reasonable proposition for me to use pay in 4 as a really cost-effective way for me to buy a new computer or a new television like that, just from a that from a value prop perspective makes sense for both the consumer and the lender. I worry that as that market shifts into, financing groceries or deferring payments on burritos, like either as a consumer, I'm just maniacal about managing my own float, or I worry that maybe I'm starting to get tapped out on my credit card open to buy, or my, the balances of my checking accounts, or those sorts of things. And so, I think the category at this point has enough, history that, like, I think it's here to stay. I do worry about this, like, expansion vector into smaller everyday purchases.
Yeah, I think that's fair. And I think that one of the things that has been clear to me for a little while with BNPL is it is additive to credit cards in a way that kind of reminds me a little bit of the boom in like online personal lending like 5-7 years ago. You remember that, when suddenly it became push button easy to get a personal loan to refinance your credit card debt. And I think FICO, if I'm remembering right, actually had to update their scoring model to account for the fact that people were getting sort of a unnatural boost in their credit score because like their level of debt would go down. Hey, suddenly like your credit card balance is gone. That's fantastic. Congratulations. But what it actually was someone refinancing their credit card debt at a lower rate so they could pile more debt onto their credit card, right? So it wasn't actually changing their behavior. It was sort of artificially like this new source of liquidity that kind of came into the market and kind of repriced different categories. I see more kind of classic pay in four BNPL, like you're describing, this like short term, very small dollar, as in a lot of ways, like being additive to like high credit card balances. And some of the research I've seen on BNPL suggests that a lot of its usage is not like replacing credit card debt, but is more like additive to credit card debt. And I guess a question I'll bounce back to you on this is that would be a challenge in and of itself. But the difference this time around, last time this happened with online personal loans, FICO could update its models and the bureaus were capturing all of this data. That is not necessarily the case this time because BNPL is a little off the radar of traditional lenders. How are the lenders you're talking to kind of thinking about that challenge?
Yeah, no, it's a good point. And just building off of your framework, right? There's am I competing with the credit card, or am I kind of adding to the consumer's debt load? And I would, if you categorize BNPL into electronics, tires, and mattresses versus convenience purchases, one feels more competitive, one feels more additive at a moment when you can't really get your arms around like just how additive it is because of the lack of bureau reporting associated with it. So it definitely is a concern. And it's a growing category also, which then almost takes this blind spot and makes it even larger.
Just really quick, do you think we are going to be getting data from the BNPL companies in the bureaus anytime soon?
I think it will happen. You said anytime soon. I wouldn't bank on within the next 12 to 18 months. But I think as it becomes a more legitimate, like long-lasting product category, I almost think you have to, right? Because if part of your value proposition is you're helping customers sort of navigate through the world of consumer credit, part of your responsibility in doing that is giving them credit where credit's due when it comes to reporting it to the bureau.
Yep, absolutely. I totally agree. I've banged that drum so loudly and so long that I think people are getting annoyed with me for talking about it, but there we are. So circling back to the whole is this in steady hands conversation, which the more I think about that, the more I just love that framing for these different asset classes. Let's talk about auto lending. Because I would say, just again, talking to a bunch of people in this space, and you talk to way more credit risk people than I do, subprime auto is the one everyone is scared of. And I think the question in auto and in subprime auto in particular is this a canary in the coal mine for the overall state of consumer credit worthiness and credit performance? Or is it more specific to either that segment of customers or to that particular like asset class and that product? And just to put a little bit of my own spin on this question before I give it to you, I do think that one thing we need to acknowledge with auto lending is that it is very, I'm trying to think of the right way to describe this. It's it's almost like a different model in the sense that the dealers are right in the middle of it. And so like the fact that it's indirect makes it much more subject to strange incentives, right? So like to give one example that I know credit risk people pay a lot of attention to, the term length of auto loans is way longer than it used to be, right? You would probably have a better sense of exactly what it is these days. But like the old idea of getting an auto loan that's like 3 to 5 years, that's a very antiquated notion compared to what happens when you go into a dealership today. And like the fact that that term has changed has profound implications for kind of the credit risk environment, but it also is happening because the lenders are competing for the business of dealers who are in the business of moving metal, to use the industry terminology. So can you give us a sense of like, is what's happening in auto lending, first of all, what's happening? And second of all, is what's happening in auto lending indicative of a larger problem, or is it more specific to auto?
Yeah, my sense in summary is that it is something to watch for sure. And on the Family Feud board of things Dave Wasik is worried about, it's not number one. We might talk later about number one, but it's on the board. I mean, a couple things. One, auto delinquencies have gone up more than credit cards, way more than even personal loans during the last 4 or 5 years. And then within auto, subprime auto has gone up even more than the asset class on average.
And we've seen some specific failures in the subprime auto space in particular. And some of those are more like kind of one-offy in terms of fraud or other things. But like we've actually seen some pretty significant either pauses in new origination or failures outright of subprime auto lenders.
Yes. And, if you're referring to the tricolor implosion, like to me,
that one seems more fraud oriented. Yeah.
Well, I'm not speaking with any inside knowledge on this. Like, I think that was like the worst product market fit ever, right?
For this moment in time.
Yes, exactly. You have a business whose stated strategy is to offer auto loans to immigrants with light or no documentation at a moment where like that's just on its face a bad idea in light of the world we're living in. I don't then extrapolate that particular example into, and therefore the subprime auto category is in trouble. But I do. I mean, again, going back to the Great Recession, I mean, auto and subprime auto in particular was the other asset class that performed extremely well, or at least relatively well during that time. And I remember the saying back 15 years ago was, "Well, you can't drive your house to work, so
you can sleep in your car.
You better stay current on your car." And I wonder if we look ahead to like what the next credit downturn might look like. Does the emergence of work from home, that didn't exist 15 years ago. Ride sharing through Uber and Lyft didn't exist 15 years ago. I wonder if auto's place on the payment hierarchy will be as strong in the next recession as it was during the last recession.
Well, that's a great point. And I hadn't thought about that, but it is really interesting because the other thing I'm seeing a lot across, I guess, just the economy broadly is more stratification by income, right? And so like the points you bring up are a great one, right? If I am a relatively high earner, it's probably more likely that I might have a job where I work remote and I don't have to drive all that often. It also is probably more likely that I might work in like an urban environment where it might not make as much sense to own a car versus just to use Uber and Lyft when I occasionally need to get places. So you could see an argument that if a credit downturn hit the economy broadly and performance across all income segments and all FICO segments kind of started to degrade, that you might see payment hierarchy choices made in auto for higher income earners be very different, where it's like, I don't even really need my car. So like if I have to make a hard choice here, I'm fine without the car. By contrast, though, and this kind of ties back to subprime auto lending a little bit, I would imagine, and you can correct me if I'm wrong, but like we might see the inverse for lower income consumers, right? Because lower income consumers, they might be ones who are driving for Lyft and Uber as their job, and like the car is the thing they need. Or, you know, the classic example is always like, I need my car because I work in construction or whatever. Like those types of things, and this has always been something that's actually buttressed the subprime auto lending space, I've noticed, is that if you get the right dealer partners and you get the right customers, they might fall apart everywhere else from a credit performance perspective, but auto is like the one that they religiously protect and stay current on. So do you think it's possible we might see more of a split between different segments of consumers if we were to get to a credit downturn?
That's I think part of what like tempers my nervousness about subprime auto as a category is that like the level of necessity of having a car, a reliable car, if anything, as you say, seems higher for lower income occupations. And again, we're painting with a broad brush, but but I definitely see and agree with your point. I also, just going back to your like the 7-year term auto loan. If you remember, back post pandemic when there were all the supply chain problems, like used car prices went through the roof, and a lot of what led to the shift from 3 to 5 year auto loan terms to 7-year auto loan terms wasn't just driven by the level of competition. It was also just
the pricing and availability of cars.
Expensive. That like they really didn't even have a choice. And so, of course, used car prices have fallen. New car prices have at least moderated. And so that's not quite as hot of a topic right now, but that definitely contributed to the extension of the terms.
No, I think that's right. And I think that, one of the things, and this is a tangent that we probably don't have time to get into, but I think it is interesting, is embedded lending is great. It works well. In my experience, embedded lending tends to eat direct lending in most categories, if not all categories, over time. We've certainly seen that with indirect auto just sort of taking over the direct auto lending space over the last, 30, 40 years. But I think the flip side to it that's interesting is indirect lending or embedded lending can really warp incentives, right? And so like a thing that I would even sort of think about if I was a regulator kind of looking at this space holistically is like, what's the relationship between indirect auto lending and the price of vehicles, right? Because like if I can finance this and my auto lending partners are getting sort of a spiff or a kickback based on the business that they're bringing to me, and they're willing to be flexible in terms of the terms that they offer to make these cars appear more like affordable. Like there's a whole kind of set of incentives wrapped around that make it, everyone listening has bought a car or two, I imagine, over time. Like you never are really sure what's going on until you walk out of there, and you just sort of hope that you got a good deal. But like, I feel like the car buying experience has become even less sort of transparent and straightforward than it used to be, which is saying something, given that 20, 30 years ago, it wasn't exactly the greatest experience either. So definitely a category to watch out and look at. I'm going back to your Family Feud. I want to try to guess the one that's at the highest on your board. You didn't prep me this way, but I'm going to try to guess. We haven't talked about student lending yet. Should we talk about student lending?
Sure. That's on the board for sure.
Is it not the highest one?
No.
Okay, we still are looking for the highest one. All right, but give us your quick take on student lending.
I've got to keep people in suspense for the end
You're doing a good job.
The episode. So, just as a quick retrospective on where we've been in student loans over the past, 6 years. Pre-pandemic, it was business as usual. The only thing I'll note is pre-pandemic, the Department of Education was the world's most lenient debt collector, and so for forbearance programs were relatively prevalent and generous, but the system was working, albeit with reasonably high delinquencies. Then, of course, pandemic hit March of 2020. Federal student loan payments get paused through the CARES Act. It blew me away when I was researching for this podcast. Like, it was 3.5 years between the implementation of the CARES Act and August 23, which was when payments were expected to resume. Then another full year of what they called the on-ramp, which was, hey, we expect you to make payments, but if you don't, we won't report it to the credit bureau or anything like that. So that adds yet another year. And so a lot of us on the credit side have been waiting in suspense to know, gosh, during that on-ramp period, how many people are actually making payments. And then, of course, early this year, we saw the grand reveal, and not surprisingly, like, there's a whole lot of delinquent student loans out there. That's driven, I think, by one. I think it's an illustration of just the overall debt burden that consumers have, but it's also driven by a couple of other things. One is, during that 3 to 4 year time period, if your student loan in 2019 was on auto pay, then most likely that auto pay no longer worked when you came back to payments. Your servicer for your student loan was likely to be different. A lot of the student lending servicers weren't doing much in that business during that intervening 4 years. And so that led to a bunch of, both on the consumer side and on the servicer side, a lot of opaqueness and chaos in terms of reestablishing, knowing who your servicer is, making sure your auto pay worked. And so I think that was a contributor to the really high delinquency rates, which have, again, over the last few months started to come down. One thing we also monitor is, for consumers who are severely delinquent, 90 plus delinquent on their student loans, how much of a spillover effect is that having to their credit cards or their auto loans? Because, again, that's where this becomes a very real problem for the lenders as opposed for the Department of Education, is does that spillover effect happen? And so far, that's been pretty reasonable and moderated. We haven't seen that spillover effect happen in a significant way. A couple of things I worry about. One is just the massive scale of this asset class. You've seen the same reports about 10 million people have more than $40,000 of unpaid student loan debt. It's huge, and even though historically the Department of Education has been a lenient debt collector, of course they have rights to collect that most lenders don't have. They have the right to garnish wages and tax refunds without filing a lawsuit. You don't discharge a student loan repayment in the event of a bankruptcy. So they actually have tools in their toolbox that, as they kind of ratchet up their level of intentionality, I worry about what that could look like over the course of next year. We don't think much has happened so far in the garnishment space, but every sense we have is that that's going to ramp up over the course of next year.
Yeah, you touched on the area I wanted to push out a little bit, which is that, I guess, public policy aspect to student lending, right? And this is the thing and I've written about this, but the thing that fascinates me about student lending is it is both, it's kind of like mortgage, I guess. Like, it is a financial product, but it is a financial product that the government has wrapped a lot of its own sort of public policy priorities around. And I think the challenge with that, and you can say this was true when we paused student loan repayments. I think it was particularly true when we allowed student loan repayments to resume, but held off on furnishing the data to the bureaus or like having that data show up. Like, these are all policy choices that you make. But the problem is when policy choices sort of overlap with the role of the private market, and even if it's the Department of Education making these loans, like, loans don't exist in a vacuum, right? Like, to a consumer, my student loan and my credit card and my auto loan are all obligations that I have. My mortgage that was resold to Fannie and Freddie, like, they all sit next to each other and affect performance and affect that payment prioritization that we've been talking about. And it seems to me that one of the successes with mortgage relative to student lending, at least recently, has been that in mortgage, we kind of just set the rules and we sort of just leave them somewhat alone. And so there's at least a level of predictability. And in student lending, that had been the case. But I worry that student lending, with the Biden administration and now with the Trump administration, is starting to become way more volatile on the policy side. And that we don't know how that's going to affect performance on the lending side. But the example you gave is a great one. I've been brushing up myself on like all of the tools that the Department of Education has at its disposal if it wants to use them to get repaid, as you just outlined. I mean, they are way more powerful as a servicer and collections organization than any other lender by far across all those dimensions that you mentioned. And, I mean, not to bend this too far in the political direction, but like, the current administration is in some very specific fights with specific higher ed organizations, right? Like, it is not insane, I don't think, to suggest that they might decide, hey, if you're really delinquent on your student loan debt that you have for your Harvard undergraduate degree, you're going to get a very different treatment than you get if you went to this public state school in a red state. Like, I wish I could say that that's crazy and like they would never do that, but I don't think that's true. And so I guess going back to the kind of credit risk perspective on all of this, like, this is where the art and I would imagine kind of the wargaming scenarios come in for right. Credit risk officers who have to think about this stuff, right?
Yeah, for sure. I mean, if I take a step even farther back, just the premise of like the value of a college degree is even in question in a way that it's never been in my lifetime.
Right.
Like the idea of a college degree often funded by a federal student loan is not like on its face like a good thing. Like that is in question in a way that it's never been in my life. And
totally,
we're hearing rumblings about there's a category of federal loan called Grad Plus loans, which are targeted explicitly for grad students. And so when you take like the potential suspension of the Grad Plus program, combine that, because again, this is intertwined with student visas and H-1Bs and all of that, like the whole state of graduate degree education starts to get called into question, which is, again, topic for another day or another podcast, but it's definitely jarring. And again, it I think is one of that uncertainty combined with just the size of the asset class is the thing that gives me pause.
Yeah, no, I think that's right on. And I think that uncertainty applies both to future demand for student loans and how, like, I mean, you could imagine a scenario where fewer young people 5 years from now are getting student loans or going to college. And like, on the one hand, you sort of wonder, like, how, if at all, does that affect their employment prospects and their ability to earn a good income? On the other hand, as a lender, you might look at it as, hey, there's some opening in their monthly budget that we could fill with other products, right? So like, there's an interesting impact there. But I also think it applies to, and this is kind of the emotional side, I think, of that payment prioritization thing that we talk about. Like, sometimes it's like utility, like I need a card because I need this liquidity. I need my car because I have to get to work. Sometimes it's emotional too, right? Like, If I get a car and the car is horrible and just is always breaking down and I'm just mad at my car and the dealership who sold it, that emotion will probably leak into how I think about prioritizing my payments for my car. Like it's not just like, oh, my auto loan came in, I need to pay my auto loan. It's my auto loan for my piece of shit car that I hate came in, I don't want to pay that. And I think that to a degree, you could see a similar thing with a generation of people with college degrees, where it's like, if the value proposition of a college degree, which is a value proposition that plays out over decades, changes in the middle, you could also imagine a emotional reaction that the borrowers would have to that and go, I don't even use my college degree. I think it's the biggest mistake I made in my life so far. I'm not going to prioritize paying that. And then like, that puts the Department of Education in a weird position. And then they have to decide how much they want to try to encourage that versus acknowledge the reality that the social deal we made around college changed. So I'm already taking this into a totally different podcast, but I do, maybe we can have you back to like delve into that deeper, because I think that's a fascinating area. Dave, I can stand the suspense no longer. What is at the top of your Family Feud board?
Private credit, Alex.
Oh, good. I was hoping we'd get to that
at the top of the board.
Okay.
It's my job to be a paranoid belt and suspenders credit nerd. And when I think about private credit, I mean, a few things come to mind. One is it's massive, right? Yeah. Estimates are that it's $2 trillion in loans outstanding. It's growing rapidly. But we go back to the sort of the steady hands comment from earlier. It's hard for me as a risk manager to manage risks that I can't like articulate and dimension and mitigate. And my worry about the private credit market broadly is like, one, it's huge. Two, a lot of the like more traditional lending safeguards like loss reserving and 3 lines of defense and a strong set of financial regulators. Like a lot of those safeguards they're certainly not mandated, and if they do exist, that's just based on the choices and decisions made by the private credit lenders. And then the other piece I worry about is the like interdependence of all of the different bets and the leverage associated with the different bets, where like, let's say I'm a private equity fund and I've made a set of bets on housing, and then also a separate a set of bets on consumer lending, and then something unexpected happens. There's a shock to housing prices. There's a shock to the economy that leads to spreads tightening. Like, because of the leverage aspect of it, like what does that mean? Like, what does it mean not only for the ultimate investor in the private credit, but for the lending institutions who are like the borrowers, basically. And I think back 20 years ago when every few years the securitization market would seize up.
Yeah.
Like, I worry that this could be an even bigger version of it. And again, I'm not making a data-driven argument, but in some ways that's kind of the point, right? Because I don't have
data
to either like corroborate or refute what I'm saying. And so, I worry about the kind of thing we saw during the housing crisis of this sort of cascading set of impacts. And as we said earlier, this is all emerging at a point when like our banking regulatory structure is impaired, and so I'm concerned about it, and it just seems like a really, really big asset class that's not well understood, and without a lot of the like safeguards that we've come to expect from our banks.
Yeah, it's fascinating. I mean, I totally agree with everything you said. The regulatory aspect is interesting because I think in some ways it really ties back to your steady hands framing, which is after the Great Recession, we basically sort of said we don't trust the steady hands that exist within the banking perimeter. And so we are going to create capital rules that require you to not do these things. And that we essentially pushed that risk outside of the regulated
Hmm.
perimeter. And
Yeah.
so strangely, even though I completely agree with your point about like the gutting of the current like regulatory structure and just like the loosening of a lot of those things, I think in some ways the growth of private credit was a function of over regulation in some senses and
Hmm.
pushing risks outside the regulatory perimeter.
Yeah.
Because you hear like, I mean, Jamie Dimon talks about this all the time. He like, it's like we'd love to do this lending, but we're not allowed to with our capital ratios that we have to have and how the risk weighting on capital works. And as I think we potentially see the loosening of some of those restrictions over the next couple of years under this administration. Strangely, we might see some of this come back into the
Mm.
regulated bank perimeter. I think, again, Jamie Dimon had a quote that was around some of the sort of initial problems we're starting to see crop up in private credit, where he's like, there's a lot of cockroaches around. Like, I
Mhm.
think that comment kind of speaks to this idea of like, whose hands do we want these risks in? And what things are sort of existing outside the regulatory perimeter. And it's a very credit risk nerd thing of you to say that like the biggest risk you worry about is the thing you don't have any data on. But I think like that is
Right.
exactly it's the unknown risks that end up being the ones that really can kill you. The other thing that I want to just mention real quickly on private credit that I'm fascinated by is I've learned to see the world through more of an accounting lens since Kia Hazlitt, my colleague, joined Fintech Takes because she's obsessed with bank accounting. And so she talks all the time about like CECL and about, the accounting
Right.
rules for assets that are available for sale versus held to maturity and like all of those kinds of things. It strikes me that none of that applies to private credit at all, right? And so one of the
Right.
things I worry about with private credit, and it does very much rhyme with the housing crisis and the Great Recession. Remember in the movie The Big Short, where he keeps calling up Goldman Sachs and he's like, why are you not updating my swaps? And then they wait and they wait
Yeah.
and they wait. And then when finally they secure the right positions themselves, they update the swaps to reflect reality, but they like wait to do that
Right.
until they've sort of like moved the market. Private credit
Yep.
feels like it could work or end up working in a similar way because there are no accounting rules that apply to like when do you have to update your positions, like when do you have to do these things, like it's all private, and so you can kind of do it however you want. And to me that's fine in private credit when we're talking about these big bespoke corporate lending versions of private credit, which is what private credit used to be, right? Like we loaned
Right.
Coca-Cola $750 million. Like that's a very bespoke private credit agreement that has all these covenants and rules that manage it. Like whatever, that's fine. Where private credit gets scary is when that private structure gets applied to asset-based finance, where the
Mhm.
thing that is the asset on the other side is not Coca-Cola, it's all of these individual loans made by fintech lenders where, again, to your point about steady hands, there's no one looking at this holistically. There's no one looking at it who's subject to a set of either regulatory or accounting rules. And it's just kind of this black hole. So just to put a final point on it, I think everything that you described about the challenges with private credit, and it kind of reminds me of like dark matter, where it's like you hear astrophysicists say like 70% of the universe is dark matter, and it's like, well, what the hell does that mean? And they're like, we don't know, and it's like private credit reminds me a little bit of that, where it's like, yeah,
Yeah.
we know it's really big, we know it's 70% of the universe, but we don't really know what's in it. Like that's to anyone who manages risk for a living, that is justifiably scary. Dave, as long as I have you here, do you mind if I ask you about one more thing that's been kind of top of mind for me?
Of course.
So credit scoring. Um,
Yeah.
Obviously, and I've written a lot about this. The credit scoring market is, I think, more in flux and more sort of fractured and chaotic than I ever remember it being. And
Hmm.
my tenure working in this industry, and I think you're similar, overlaps roughly with like FICO's dominance as like the provider and the standard. So, in the same way that we
Right.
talked about like the social contract around getting a loan and going to college is changing for the first time in my lifetime. I kind of feel the same way about credit scores. Like for the first time in my lifetime, we are seeing kind of meaningful breaks with FICO not being the standard for mortgage securitization, which obviously is the thing that's really been sucking up a lot of the headlines lately. I think more subtly, it ties back to some of the things we were saying about buy now, pay later is not furnishing data to the credit bureaus. I refuse to let us get sucked into the black hole of credit builder products, but like that's another category that's sort of impacting the fidelity of credit data and the impact on credit scores. You see, I've been fascinated with like what Cash App is doing recently, where like they've developed their own little scoring model, and now they're actually making it something that's visible to Cash App customers, so they can see their Cash App score and can kind of monitor and manage that. I mean, we're just seeing like a fracturing of the credit scoring space from a standard perspective that I think we've never seen before. And I'd be curious to get your take on sort of a couple of things. What does this mean for like the credit scoring market overall? And like, obviously I would say for FICO, like a large part of their value prop for many years and the strength of their business has been FICO, not so much as an analytic tool, which is excellent, but not like uniquely excellent. Versus FICO as like a standard in the market for investors or for regulators or for consumers, which is kind of starting to break apart a little bit, as well as like from a credit risk perspective. I mean, you come from kind of the Capital One school where, I mean, for decades, since the beginning, really, Capital One, I think, and other large lenders have been like, the FICO score, we can outperform the FICO score. Like, I don't know that for large lenders, they really see a huge difference necessarily between where they were and now. But, you go down a couple tiers in the market to other lenders, like they rely on the FICO score as a pretty significant input to their lending decisions. Curious maybe how that might be shifting. So like, what's your take on this sort of fracturing of the credit score market right now?
Yeah, it's a great question. A couple of thoughts. One is what I'll call the democratization of data sciences and risk modeling.
Yeah.
Which is that, as you said, like back in the olden days, there were companies like Capital One who for many years have, not used FICO score as a variable in their models. They, I think, philosophically and analytically see much better results by, using the kind of component features.
Yep.
And, the number of lenders that say, look, like using the FICO score as a simplistic credit policy is just not anywhere close to competitive these days, right? And so that as, through cloud computing and through a lot of the, advanced data science tools that have come out in the last 10 years, like the number of lenders and the percentage of the kind of lending activity being done that are relying more and more on the kind of constituent parts of FICO rather than the FICO or the Vantage score as an input variable is getting higher and higher.
Yeah.
And as you say, like that then means that while FICO is still useful in terms of being shorthand that everybody, it's an agreed upon industry standard and it's a great way to stratify your data, like it just isn't as much in the guts of sophisticated data science models as it has been in the past. Then, of course, there's a bunch of new data sources out there.
Yeah.
You and I both spoke at the Nova Credit conference.
That's right.
And I guess one thing that was striking to me about that conference, having been there now 2 years in a row, is it felt like in 2024, cash flow, like the subtext of that conference was a pitch for the value of cash flow underwriting.
Totally.
Whereas just a year later, it was as if like, hey, that's like, we don't have to sell you anymore.
The pitch was like, how do we operationalize it? All that kind of stuff. Yeah.
Yeah. And so just for the industry to have made that much progress in a year where there are many more active use cases being implemented, there's a lot more proofs of concept happening, shows just the speed with which cash flow underwriting is being taken on. And then I guess the other thing I'll say is that like lenders aren't just competing based on the content of the data. They're competing on the speed with which the data is available. So the old paradigm, and this isn't just a FICO issue, this is true for the bureaus in general, of, well, I get a monthly statement file and, I get a monthly refresh of the credit bureau.
Yeah.
Like, that's just not competitive anymore. I mean, there are more and more what I'll call velocity related variables being included in models. So not just like, did you make your payment 45 days ago, but how many new trades do you have in the last week? How many loan repayments have you made in the last 4 days? How many transactions have you carried out on your card? Those like intraday or certainly intra-month indicators. Like that's one of the future frontiers here. And I think some of the emerging data sources are just more adept and equipped to take advantage of that.
Yeah, I think all of that is exactly right. And it's interesting because you're already even seeing FICO adapt to this new reality, right? And so like FICO is, and I'm going to have you back and we're going to talk a whole thing about generative AI because we didn't get into that. But like FICO is doing its own spin on language models and transformer architectures. They are they announced I guess, relaunched version of Ultra FICO, which I was at FICO the last time they launched it, and it was, I would say, more a storytelling exercise than an actual like market initiative. Whereas this time it seems like, no, the market's ready and we're FICO and we can do this. So even within FICO, you're seeing kind of a fracturing of their scoring products in a way that I think kind of reflects that changing reality that you're describing. And I mean, in some senses, I think it's never been a better time to be a chief risk officer because you have just like so many more tools in the toolbox. You have so many more people with those skill sets that you were talking about because that's been kind of democratized. There's more access to data. I think the stranglehold of like, that's not FCRA data that kind of existed in like the early 2000s, or like that's not Reg B compliant. Like that stranglehold seems to be loosening a little bit, and we're a little more open to trying different sort of techniques for evaluating risk. At the same time, it feels like as a consumer, it's never been harder to understand what you're qualified for, or like if you have good credit, or if you do in the eyes of one lender versus another. So in some ways, I kind of think that the market is sort of diverging between like getting better and giving more options for lenders and becoming confusing and more difficult to navigate for consumers. And I'm curious to see how those two parts of the market will eventually kind of reconcile with each other. I've been selfish in keeping you way too long. Actually, listeners don't know the half of it because I was late to get to this podcast, and Dave was very generous in hanging on. I really enjoyed this conversation, and if it's not too much trouble, could I have you come back again?
I'd love to. Yeah, thanks so much, Alex. Great to see you, and thanks for everything you're doing for the industry.
Oh no, it's my pleasure. Nerding out on this stuff does not feel like work at all. This was a joy to record, and we'll talk to you again soon.
Thanks.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.